The biggest risk to the global economy today is probably not what most people think. It's not artificial intelligence replacing jobs. It's not political drama in Washington. And it's not even the growing rivalry between the United States and China. The real risk is something much quieter, something so technical that most people have never even heard of it. And because it sounds boring, almost nobody is paying attention. But if you've been wondering why mortgage rates remain stubbornly high, why stock markets suddenly panic out of nowhere, and why central banks talk about easing conditions while borrowing still feels expensive, the answer might not start in Washington, London, or New York. It might actually start thousands of miles away in a country that rarely appears in financial headlines anymore: Japan. More specifically, it starts with the way Japan has quietly shaped the global financial system for decades. To understand why Japan matters so much, we have to go back more than 30 years. In the late 1980s, Japan experienced one of the largest financial bubbles in history. Real estate prices exploded, stock markets surged, and the country's economy looked unstoppable. At one point, the land under the Imperial Palace in Tokyo was said to be worth more than the entire state of California. But bubbles don't last forever. In the early 1990s, that bubble collapsed. Stock markets crashed, property prices plunged, and Japan entered a long economic slowdown that would later be called the lost decades. For years, economic growth was weak. Inflation disappeared. Wage growth slowed dramatically. It was as if the economy had been frozen in time. To fight this stagnation, the Bank of Japan started experimenting with policies that most central banks had never tried before. Interest rates were cut to nearly zero. When that wasn't enough, they pushed rates even lower. Eventually, they introduced a policy designed to control long-term interest rates directly. In simple terms, the central bank promised to keep government bond yields extremely low, no matter what the market wanted. This created a strange situation for Japanese investors, because if you were a pension fund, an insurance company, or a large bank in Japan, your safest investments were suddenly paying almost nothing. Imagine managing billions of dollars but earning close to 0% on government bonds. That leaves you with a difficult choice: either accept almost no return, or start looking for opportunities somewhere else in the world. For decades, Japanese investors chose the second option. They began sending enormous amounts of capital overseas. They bought U.S. Treasury bonds. They invested in foreign real estate. They purchased corporate debt and global equities. Over time, Japan became one of the largest foreign investors on the planet. In fact, Japan eventually became the world's largest creditor nation, which is simply a formal way of saying that Japan was lending money to the rest of the world. But there was another reason this global investment wave became so powerful. Japanese interest rates were extremely low, which meant investors could borrow money in Japanese yen at very cheap costs. And that created something known in finance as a carry trade. Here's a simple example. Imagine an investor named Alex. Alex borrows money in Japan at an interest rate close to zero. Then Alex converts that borrowed money into dollars. With those dollars, Alex buys assets in another country that offer higher returns. Maybe US government bonds, maybe technology stocks, maybe emerging market investments. As long as the return on those assets is higher than the cost of borrowing in Japan, Alex earns a profit. And when borrowing costs are extremely cheap, this strategy becomes very attractive. Over time, millions of investors began doing something similar. The result was a massive flow of money from Japan into global financial markets. This helped keep borrowing costs low around the world. It supported rising stock prices. It fueled real estate booms. And it quietly became one of the largest sources of global liquidity. But there was always one hidden assumption behind this system. It only worked if Japanese interest rates stayed extremely low. For decades, that assumption held true, until recently, because after years of ultra-loose monetary policy, Japan has slowly begun changing direction. Inflation has started appearing again. Wages have begun rising. And the Bank of Japan has started allowing interest rates to move higher. At first glance, that might sound like a small technical shift. But in financial markets, small shifts can have enormous consequences. Because if Japanese interest rates rise, borrowing money in yen becomes more expensive. And when borrowing costs increase, the entire carry trade becomes less attractive. Investors who once borrowed cheaply may start closing those positions. Instead of sending money abroad, they may begin bringing capital back home. This process is known as repatriation. And when large amounts of global capital start moving in the opposite direction, markets notice. Because for years, the global financial system quietly benefited from this steady flow of Japanese money. It helped finance government debt. It helped support asset prices. And it helped keep long-term interest rates relatively stable. But if that flow slows down, someone else has to step in. Otherwise, yields may need to rise to attract new buyers. And this is where things start affecting everyday life. Because long-term interest rates influence far more than just government borrowing. They affect mortgage rates. They affect corporate financing. They affect how investors value stocks and real estate. If long-term rates remain elevated, borrowing becomes more expensive across the entire economy. Homebuyers face higher monthly payments. Companies think twice before expanding. Investors become more cautious, and financial conditions tighten, even if central banks begin lowering short-term interest rates. This is why the bond market plays such a critical role in global finance. It quietly sets the foundation for almost every other asset price. And when supply and demand for bonds change, the effects ripple across the entire system. Yet most headlines rarely focus on this. Financial media tends to chase dramatic stories, artificial intelligence breakthroughs, political conflicts, tech stock rallies. Those topics generate clicks and attention, but the deeper structural forces often remain in the background. The truth is that financial risks are rarely obvious. The loud threats are usually already priced into markets. The more dangerous ones are often the quiet shifts happening underneath the surface. And right now, one of those shifts may be the slow transformation of the global liquidity system that has existed for decades. For years, the world benefited from extremely cheap money flowing out of Japan. If that era begins to change, the consequences could spread far beyond Japan itself. Because in global finance, liquidity is like oxygen. When it flows easily, markets grow and expand. But when that flow tightens, everything begins to slow down. And sometimes the biggest risks are not the ones making headlines. They are the ones hiding in plain sight.